Investing in your 20s and its significance for building wealth. Hey there, future financial wizards. Today, we're diving into a topic that's crucial for anyone in their 20s, investing. If you've ever wondered how to turn your hard-earned cash into a wealth-building machine, you're in the right place. In this video, we'll explore various investment strategies tailored for young adults, from stocks and bonds to real estate and retirement accounts. Starting your investment journey in your 20s is not just smart, it's essential. The earlier you begin, the more time your money has to grow, thanks to the magic of compound interest. Imagine watching your savings multiply over the years while you focus on living your best life. We'll also discuss practical tips to help you navigate the investment landscape, making it engaging and easy to understand. So, whether you're a complete newbie or just looking to sharpen your skills, stick around. Let's unlock the secrets to financial independence together and set you on the path to building lasting wealth. Understanding the basics of investing, fundamental concepts every beginner should know. Alright, let's break down some fundamental investment concepts that every beginner should grasp. First up, we have stocks. When you buy a stock, you're purchasing a small piece of a company, which means you can benefit from its growth. Next, we have bonds. Think of bonds as loans you give to companies or governments in exchange for interest payments over time. Lastly, mutual funds pool money from multiple investors to buy a diversified portfolio of stocks and bonds, making it easier for you to invest without needing to pick individual securities. Now, let's talk about risk tolerance and investment goals. Understanding how much risk you're comfortable taking is crucial, as it influences your investment choices. Are you a conservative investor, or do you prefer a more aggressive approach? Finally, it's essential to distinguish between saving and investing. While saving is about setting aside money for short-term needs, investing is about growing your wealth over time. By investing, you're putting your money to work, allowing it to potentially grow much faster than traditional savings. Setting financial goals, a guide to establishing clear financial objectives. Let's talk about setting financial goals, an essential step in your journey to financial success. First, it's important to identify both short-term and long-term goals. Short-term goals might include saving for a vacation or paying off credit card debt, while long-term goals could involve buying a home or planning for retirement. By clearly defining these objectives, you create a roadmap for your financial future. Next, let's discuss the importance of creating a budget. A budget helps you track your income and expenses, ensuring that you allocate funds toward your goals. It's like a financial blueprint that keeps you on track and accountable. Remember, budgeting isn't about restriction. It's about empowering you to make informed choices. Lastly, don't overlook the role of an emergency fund in your financial planning. This fund acts as a safety net, covering unexpected expenses like medical bills or car repairs. Having an emergency fund allows you to stay focused on your goals without derailing your progress. So, start setting those goals, create a budget, and build that safety net. Your future self will thank you. Types of investment accounts. A guide for young investors. When it comes to investing, choosing the right account is crucial for your financial journey. Let's explore some of the most common types of investment accounts available for young investors. First up, we have brokerage accounts. These are flexible accounts that allow you to buy and sell a variety of investments, like stocks and bonds, without many restrictions. They're great for those looking to invest for short-term goals or simply to grow their wealth. Next, let's talk about IRAs, individual retirement accounts. There are two main types, traditional and Roth IRAs. Both offer tax advantages, but they work differently. With a traditional IRA, you can deduct contributions from your taxable income, while Roth IRAs allow your money to grow tax-free, so you won't pay taxes on withdrawals in retirement. Lastly, we have 401(k)s, employer-sponsored retirement plans that often come with matching contributions. This is essentially free money. When choosing an account, consider your financial goals and how each option aligns with them. The right account can make a significant difference in your investment journey. Building a diversified portfolio. The importance of diversification in investment strategies. Let's dive into the concept of diversification and why it's a cornerstone of smart investing. Simply put, diversification means spreading your investments across various asset classes to reduce risk. By not putting all your eggs in one basket, you can protect your portfolio from significant losses if one investment underperforms. In fact, a well-diversified portfolio can enhance your overall returns by balancing out the highs and lows of different investments. So, what asset classes should you consider? A balanced portfolio might include stocks for growth, bonds for stability, real estate for income, and even commodities like gold for a hedge against inflation. Each of these asset classes reacts differently to market conditions, which helps cushion your portfolio during downturns. Remember, diversification isn't a one-time task. It's essential to conduct regular portfolio reviews and make adjustments based on market conditions and your evolving financial goals. By staying proactive, you can ensure your portfolio remains aligned with your risk tolerance and investment objectives. So, start building that diversified portfolio today for a more secure financial future. Investing in stocks versus real estate. Comparing benefits and drawbacks. When it comes to investing, two popular options are stocks and real estate, each with its own set of benefits and drawbacks. Let's start with stocks. The stock market offers the potential for high returns, especially if you invest in growth companies or index funds. With the right strategy, your investments can appreciate significantly over time, and you can benefit from dividends as well. However, stocks can be volatile, and market fluctuations can lead to quick losses, which may not suit everyone's risk tolerance. On the other hand, real estate investments provide stability and the potential for consistent cash flow through rental income. Real estate tends to appreciate over time, and owning property can offer tax advantages, such as deductions for mortgage interest and property taxes. However, it requires more hands-on management and can involve significant upfront costs. Ultimately, the choice between stocks and real estate should align with your personal interests and risk tolerance. If you prefer a more hands-on approach and value stability, real estate might be for you. If you're comfortable with market fluctuations and seek high growth, stocks could be your best bet. Consider what fits your financial goals. The power of compound interest, understanding its impact on wealth accumulation. Let's talk about one of the most powerful concepts in investing, compound interest. Simply put, compound interest is the interest on your initial investment, plus the interest that accumulates on that interest over time. The formula for calculating compound interest is A equals P, 1 plus R, N, caret, NT. Where A is the amount of money accumulated after N years, P is the principal amount, the initial investment, R is the annual interest rate, N is the number of times interest is compounded per year, and T is the number of years the money is invested. To illustrate, let's say you invest $1,000 at an annual interest rate of 5%, compounded annually. After 30 years, you'd have about $4,321. Now, if you started investing just 10 years earlier, that amount could grow to over $7,389. The key takeaway? Start early. The sooner you invest, the more time your money has to grow. And don't forget to reinvest your earnings. This maximizes your growth potential and accelerates your journey to financial independence. Embrace the power of compound interest, and watch your wealth accumulate. Avoiding common investment mistakes. Pitfalls young investors should avoid. As a young investor, it's crucial to steer clear of common pitfalls that can derail your financial journey. One major mistake is emotional investing. It's easy to get swept up in market hype or panic during downturns, leading to impulsive decisions. Similarly, trying to time the market, buying and selling based on short-term fluctuations, can be risky and often results in missed opportunities. Remember, no one can predict market movements with certainty. Another critical aspect is the importance of thorough research before making any investment. Understanding the fundamentals of a company or asset class can help you make informed decisions and avoid costly mistakes. Don't rush into investments without knowing what you're getting into. Lastly, cultivating patience and a long-term perspective is vital. Investing isn't a get-rich-quick scheme. It's about building wealth over time. Markets will have ups and downs, but staying focused on your long-term goals can help you weather the storms. So, take your time, do your homework, and remember that successful investing is a marathon, not a sprint. Resources for continued learning, expanding your investment knowledge. Investing is a journey, and there's always more to learn. To help you along the way, Here are some valuable resources to deepen your investment knowledge. First, consider picking up some insightful books. Titles like The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton Malkiel offer timeless wisdom on investing principles. If you prefer audio content, check out podcasts like Invest Like the Best and The Motley Fool Money Show. These podcasts feature expert interviews and discussions that can enhance your understanding of market trends and investment strategies. For those who enjoy structured learning, online courses from platforms like Coursera or Udemy can provide in-depth knowledge on various investment topics, from stock analysis to real estate investing. Additionally, staying updated with financial news through sources like Bloomberg or CNBC is crucial for understanding market movements. Finally, consider joining investment communities, whether online forums or local meetups. Engaging with like-minded individuals can provide support, share insights, and keep you motivated on your investment journey. Happy learning! Let's recap the key points we've discussed today. Starting to invest in your 20s is crucial for building future wealth. The earlier you begin, the more time your money has to grow through the power of compound interest. Remember, diversification is essential to reduce risk and enhance returns, and choosing the right investment accounts can set you on the right path. We also highlighted the importance of setting clear financial goals, avoiding emotional investing, and doing thorough research before making decisions. Patience and a long-term perspective are vital for navigating the ups and downs of the market. Now, it's time to take action. Apply these insights to your investment strategy and watch your financial future flourish. If you found this video helpful, don't forget to subscribe, like, and share it with friends who might benefit from this information. Your engagement helps us create more valuable content for you. Thanks for watching, and here's to your successful investing journey.